Welcome back to another explainer on South African tax law. Look, we know the Income Tax Act can feel like reading a dictionary, so today we're taking that dense, complex legislative text and turning it into a high-yield tactical briefing for your upcoming Module 5 exam on exempt income. If you've been staring at the legislation wondering how on earth to structure your answers, well, you are exactly where you need to be.
All right, here is our attack plan for today. We're going to quickly cover the exemption framework, jump into local and foreign interest, tackle tax-free investments and annuities, decode dividends and foreign pensions, and then finish up with an exam technique masterclass and a final integrated revision. Let's get into it.
First up, the exemption framework. Think of this as the ultimate battle between Section 1 and Section 10. So, to actually extract marks in a tax exam, you first need to understand the fundamental tug-of-war between what gets pulled into the tax net and what gets shielded. Section 1, your gross income, aggressively pulls your worldwide amounts into your taxable framework. It wants everything. But your exempt income rules, found in Section 10 and 12T, well, those are your shields. They exist purely because of government policy, like wanting to incentivize people to save money. The absolute golden rule here? You must always, absolutely always test an amount against the Section 1 gross income definition to pull it in before you apply the Section 10 or 12T exemptions to shield it. Don't put the cart before the horse.
Moving on to our second section, local and foreign interest, specifically Sections 10.11i and 10.11h.
When we map these two out side by side, the differences are actually pretty stark. For local interest under 10.1i, the exemption exists to give everyday natural persons a little tax break, but it is strictly capped. On the flip side, foreign interest under 10.1h is designed to attract offshore capital into South Africa, so it's fully exempt for non-residents. But here is the massive exclusion. If that foreign entity has a permanent establishment, a PE in South Africa, boom, the exemption fails completely. But don't panic. The legislation has a fallback. If they lose the foreign exemption, they can actually fall back on the local exemption caps. Pretty neat, right?
Speaking of those local caps, burn this number into your memory right now. R23,800. For Section 10.1i local interest, natural persons under the age of 65 get exactly R23,800 of their interest income completely exempt. And if they hit 65 or older, that shield bumps up to R34,500. This is your baseline threshold.
Now listen closely because this is a classic examiner trap. These thresholds, they represent a full 12-month period. If your taxpayer dies or emigrates during the year, their year of assessment is suddenly less than 12 months. That means you have to apportion the threshold. And the absolute trap here? You must use exactly 365 days in your formula, completely ignoring leap years. I know, it sounds crazy, but the legislation literally does not account for 366 days. Countless students lose easy marks here, so make sure you're not one of them.
All right, Section 3, tax-free investments and annuities under Sections 12T and 10A.
Under Section 12T, tax-free investments are an incredible wealth-building tool. Why? Because they completely shield all proceeds, interest, dividends, everything, for natural persons. But examiners love to test the really strict legislative limits. R36,000 annually and R500,000 per lifetime. If your client over-contributes, you have to calculate a massive 40% penalty on that excess, which is treated as normal tax. But here is the saver, the actual principle you need to grasp. Even if they get hit with that brutal penalty, the actual proceeds generated from the investment, those still stay perfectly tax-free. They don't lose the exemption just because they broke the contribution limit.
Now for purchased annuities under Section 10A, the logic shifts completely. With these, you're essentially just getting your own capital back along with some growth. Obviously, taxing your own capital doesn't make sense, so the law lets you separate the taxable return from the exempt capital using this exact four-step formula. Y equals A over B multiplied by C. Simply divide the total cash paid by the expected return and multiply it by this year's cash received. That isolates your exempt portion.
Which brings us to a massive pitfall in the exam room, the commutation trap. When an annuitant cashes out early for a lump sum, which we call a commutation, students tend to panic. They treat the whole lump sum as either entirely taxable or entirely exempt. Actually, scratch that, neither is correct. You have to apply the math to isolate and exempt only the specific capital element of that commuted lump sum. Everything else gets taxed.
Next up, Section 4. Let's talk about dividends and foreign pensions, Sections 10.11ki and 10.11gc.
The baseline rule for local dividends under Section 1011KKI is beautifully simple. They are 100% exempt from normal tax for both natural persons and corporate entities. The whole purpose here is to avoid double taxation, since the company paying the dividend already paid corporate tax on those profits. But let's be real for a second. University examiners are absolutely not going to give you simple, straightforward scenarios. So, what you need to do is scan the exam question for two highly toxic words, annuity or REIT. Exclusion 1. If a dividend is paid as part of an annuity, it fails the exemption entirely. Exclusion 2. If the distribution comes from a real estate investment trust or a REIT, it falls under a very specific proviso and becomes fully taxable. If you see either of those words, boom, that dividend is ripped right out from under the exemption shield and goes straight into taxable income.
Now, what about foreign pensions under Section 1011GC? This is all about geography and time. You have to use an apportionment ratio based on time. Only the exact fraction of years that the person worked outside of South Africa is sheltered by the exemption. Any portion relating to services rendered inside South Africa, or honestly any payout coming from a local SA retirement fund, that gets taxed. Simple as that.
All right, Section 5, Exam Technique Masterclass. Let's talk about how you actually maximize your marks on paper.
When you're structuring your university answer, I need you to follow this exact chronological checklist. Step 1. Always include it in gross income first under Section 1. Step 2. Explicitly state the specific exemption section. Step 3. Check your beneficiary. Remember, a company cannot claim a natural person's exemption. Step 4. Test those limits. Step 5. Rigorously scan for those exclusions like PEs or REITs. And Step 6. Apportion if you have a part-year assessment. If you stick to this flow, you guarantee that you never blindly apply an exemption without first testing its legal limits.
Because here is exactly where students throw away easy marks. Let's say you have a foreign company with a South African branch. That branch is a permanent establishment. The trap? Trying to apply the R23,800 local interest cap to them. The winning strategy is recognizing that because the interest is effectively connected to that PE, it is completely excluded from the foreign exemption and is fully taxable. No foreign exemption, no local cap, just purely taxable.
Okay, we've made it to Section 6, the Integrated Final Revision. You'll want to lock these integrated rules into your memory right now. By combining multiple exemptions into one view, you can quickly cross-reference the triggers, the formulas, and the biggest examiner traps. If you can recreate these core rules in your mind during your exam reading time, I promise you've already secured the vast majority of your marks for the exempt income section.
I'll leave you with this final challenge to really test your mastery of Module 5. If a 22-year-old resident gets R40,000 in local dividends, R35,000 in bank interest, and R12,000 from a REIT, exactly how much of their gross income remains taxable after applying all the exemptions? Work through the steps we covered today. Include it in gross income, apply your interest caps based on their age, watch out for that REIT trap, and find the perfect final taxable figure. You've got this. Keep focused, practice those steps, and I'll see you in the next explainer.